Something changed, not in the headlines, not on financial television, not in the polite analyst reports that reassure investors everything is functioning normally. It changed in the mechanics. Over the past several sessions, silver didn't just pull back, it was forced down with precision. Volume surged at key technical levels. Selling pressure appeared exactly where momentum should have accelerated. And just as retail enthusiasm started to build, the rug was pulled. Again. Now here at Stone sits the question nobody wants to ask directly. Why do these moves keep happening the moment silver starts gaining structural strength? Because this isn't about volatility, it's about control. When institutions like JP Morgan and CME Group adjust margin requirements, alter collateral frameworks, or quietly shift liquidity parameters during critical price expansions, it isn't random, it isn't coincidence, and it certainly isn't accidental. It's coordinated. At least that's what the structure suggests. Let's step back. Silver is not just another commodity, it's a dual identity asset. Industrial metal on the surface, monetary metal underneath. That duality makes it uniquely dangerous in a stressed financial system. When inflation expectations rise, when sovereign debt concerns escalate, when currency confidence wavers, silver doesn't just respond, it amplifies. And amplification is destabilizing. For large institutions deeply integrated into derivatives markets, silver's upside volatility isn't just uncomfortable. It's a risk exposure problem, especially when open interest builds faster than physical delivery capacity can realistically support. This is where the mechanics matter. The futures market sets price discovery, the paper market dictates the global reference price, and the exchange, not the physical stacker, controls the rules of that arena. So when silver begins trending aggressively upward, what tools are available? Margin hikes, increased capital requirements, sudden liquidity tightening, expanded contract supply, all technically legal. All framed as risk management, all occurring precisely when bullish momentum accelerates. That pattern has played out before. Think back to 2011. Silver ran toward $50. Margin requirements were raised multiple times within days. The result? Forced liquidations, momentum collapse, price halved in months, fast forward to more recent squeezes. Retail enthusiasm spikes, social media campaigns ignite, physical premiums surge, and then, almost like clockwork, exchange level adjustments appear. The public explanation is always stability. But stability for whom? Because here is the uncomfortable truth. A rapidly rising silver price exposes structural imbalances in leveraged short positions. It stresses bullion banks. It challenges confidence in synthetic supply. And institutions like JP Morgan are not passive observers in that ecosystem. They are dominant participants. JP Morgan holds massive derivatives exposure across commodities. It operates clearing operations. It interacts directly with the exchange infrastructure. Meanwhile, CME Group governs contract rules, margin policy, and the structural environment of price discovery. When both entities make emergency adjustments in proximity to sharp silver moves, it raises legitimate questions. Are these actions defensive or preemptive? Silver's suppression narrative isn't built on conspiracy theory. It's built on pattern recognition. Each time silver threatens a breakout with macroeconomic backing, whether inflation spikes, geopolitical tension escalates, or currency weakness intensifies, structural resistance appears from within the system itself. That resistance doesn't always crash the market permanently, but it resets sentiment, it shakes weak hands, it reminds participants who controls the game. Now, to be clear, exchanges must manage risk. Clearinghouses must ensure stability. No one is arguing against functional oversight. The issue is proportionality. Why do the most aggressive margin interventions consistently align with upside breakouts rather than downside collapses? Why does volatility management seem to activate predominantly when silver rises too fast? Because silver rising too fast isn't just a trading problem, it's a confidence problem. And confidence in the fiat system is the foundation upon which everything rests. If silver signals stress, policymakers notice. If gold confirms it, central banks respond. But if silver leads aggressively, the derivatives complex absorbs the shock first. And absorbing shock requires control. This is where BullionBeyond steps in. We don't react to headlines, we analyze structure, and the structure suggests something deliberate is happening. The next question is deeper. What exactly are these emergency moves protecting? And who ultimately benefits from suppressed volatility? If you're holding physical silver, this isn't about daily price noise. It's about understanding the battlefield. Because once you see the mechanism clearly, the short-term suppression stops looking like weakness. It starts looking like pressure building underneath, and pressure, when contained too long, doesn't disappear. It detonates. To understand whether coordinated suppression is plausible, we need to move beyond emotion and into mechanics. Silver pricing does not originate in coin shops or bullion dealers. It originates in the futures complex. specifically in contracts traded under the umbrella of CME Group, where leverage defines behavior and margin defines survival. A single futures contract controls a large amount of silver relative to the capital posted. That leverage is powerful during calm periods, but during rapid upside moves, leverage becomes fragile. If price rises sharply, short sellers must post additional collateral. If they cannot, positions are liquidated. That liquidation accelerates price. The feedback loop can become violent. Now imagine you are a clearing authority responsible for maintaining systemic stability. You see volatility increasing, open interest expanding, retail participation surging, industrial demand tightening, physical premiums climbing. You also see concentrated short exposure sitting inside the system. The rational response is risk management. Margin requirements increase overnight. This forces participants to add capital or exit positions. Many cannot add capital quickly. They sell. Selling pressure appears suddenly. Price stalls. Technically justified. Structurally impactful. Here's the nuance. Margin hikes do not distinguish between reckless leverage and legitimate conviction. They hit everyone simultaneously. But because speculative longs often operate with tighter liquidity than institutional shorts, the shock disproportionately weakens bullish momentum. That's not conspiracy, that's math. Meanwhile, large banks like JP Morgan operate at a different scale. Their balance sheets absorb margin volatility more easily. Their access to liquidity is deeper. Their influence in clearing infrastructure is structural. When volatility threatens upside breakout conditions, a margin increase resets the board. Price cools, momentum fades. Narrative shifts from breakout to failed rally. Sentiment deteriorates. This is where psychology enters. Silver investors tend to be conviction-driven. Many hold physical metal because they distrust fiat systems. They anticipate monetary debasement. They believe structural shortages exist beneath paper supply. When price surges, that conviction strengthens. But when rallies are repeatedly capped through structural adjustments, fatigue sets in. Doubt replaces momentum, and doubt is a powerful suppressant. Now consider the broader macro backdrop. Rising sovereign debt levels, persistent inflation, expanding geopolitical tension, central banks diversifying reserves away from dollar concentration, industrial demand for silver increasing through solar and electronic sectors. Under purely free market conditions, these variables should support sustained upward repricing. Yet silver repeatedly struggles to maintain breakout trajectories. Why? Because the price discovery mechanism is not purely physical, it is derivative dominant. Contracts representing multiples of annual physical supply trade daily. Most settle in cash, few demand delivery. The system functions smoothly as long as confidence holds that delivery is possible if required. But what happens if confidence erodes? What happens if too many participants demand metal simultaneously? That scenario threatens more than price volatility. It threatens structural credibility. This is where suppression theory gains weight, not from emotion, but from incentive alignment. Exchanges need orderly markets. Bullion banks need manageable exposure. Governments need stable inflation expectations. An explosive silver breakout sends a message. Something beneath the surface is unstable. When price suppression occurs, it does not mean silver lacks value. It means silver's signal is inconvenient, and inconvenient signals are often managed. Look at the pattern. Each time silver accelerates with macro backing, intervention-like mechanisms appear, whether through margin adjustments, liquidity tightening, or coordinated bearish narrative reinforcement in financial media. The outcome is consistent. Rallies stall before structural breakouts complete. The public explanation remains the same: volatility management. But volatility is symmetrical. If the goal were purely stability, interventions would mirror both directions equally. Yet aggressive margin hikes cluster around upside pressure phases. That asymmetry matters. At BullionBeyond, we're not claiming a secret boardroom conspiracy. We're analyzing systemic incentives. When powerful financial institutions and exchanges both benefit from dampened upside volatility, coordinated behavior does not require explicit collusion. It requires aligned incentives, and aligned incentives are often more powerful than written agreements. So the real question becomes, is silver being suppressed because it is weak, or is it being contained because it is structurally strong? If suppression is occurring, it suggests fear of what uncontrolled price discovery might reveal, and what it might reveal could extend far beyond the silver market itself. To see the bigger picture, we need to zoom out beyond silver itself and look at what silver represents. Silver is a pressure gauge. It reacts faster than gold. It moves more violently. It exaggerates macro signals. When inflation expectations rise, when real yields compress, when geopolitical instability increases, silver doesn't politely adjust. It overreacts. That overreaction is precisely why it becomes problematic for a leveraged financial system. Consider the connection between silver and monetary confidence. When investors lose faith in fiat purchasing power, they move toward hard assets. Gold is the traditional refuge. Silver, because of its lower nominal price and higher volatility, becomes the retail gateway. And retail participation matters. When retail capital flows into physical silver aggressively, it tightens supply, premiums expand, inventory declines. Delivery pressure builds against futures markets. Now imagine that occurring during a period of sovereign stress, rising debt issuance, expanding deficits, or currency weakness. An uncontrolled silver rally would amplify public perception that something is wrong, and perception drives behavior. If silver spikes rapidly while headlines discuss inflation persistence or fiscal imbalance, the signal becomes loud. Currency purchasing power is deteriorating faster than policymakers admit. That's not just a market move. That's a narrative shift. This is where institutions like JP Morgan sit at the intersection of derivatives, liquidity, and systemic exposure. And exchanges like CME Group control the operational mechanics of futures-based price discovery. They don't need to coordinate in secret meetings to share the same priority: orderly markets. Because disorder threatens more than profit. It threatens confidence. Now let's talk about concentration. Silver futures markets have historically shown periods of concentrated short positions held by a small number of large participants. That concentration isn't illegal. It's disclosed in regulatory reporting, but it introduces fragility. If a small cluster of large shorts faces aggressive upside pressure simultaneously, the margin requirement shock multiplies. A short squeeze becomes possible. Short squeezes are violent. They are not gradual repricings. They are cascading failures of risk models. From a systemic stability perspective, preventing that cascade makes sense. But from a free market perspective, price suppression distorts discovery. Here is the contrast framing that matters. If silver were collapsing 30% in days due to oversupply, would margin requirements increase aggressively to protect longs? History suggests otherwise. Yet, when silver rises rapidly, risk management activates quickly. That asymmetry shapes perception, and perception shapes long-term investor behavior. Another layer: industrial demand. Silver is not only a monetary hedge, it is critical for solar panels, electronics, and emerging technologies. Global green energy initiatives increase structural demand. Supply growth struggles to keep pace due to declining ore grades and limited new large discoveries. When structural deficits emerge beneath derivative pricing, tension builds between physical reality and paper valuation. The longer that tension persists, the more explosive the eventual reconciliation. This is why repeated suppression patterns don't invalidate the bullish thesis. They reinforce it. Because suppression implies threat. If silver were irrelevant, there would be no need to contain it. If silver were structurally weak, upside breakouts would fail naturally. But when breakouts require mechanical intervention, the underlying demand signal remains intact. And here's where psychology flips. Most retail investors interpret suppression as weakness. They see failed rallies and assume the metal lacks strength. They lose patience. They rotate capital elsewhere. But informed investors recognize compression. Compression stores energy. Every capped breakout builds frustration. Every forced liquidation transfers metal from weak hands to strong balance sheets. Every margin hike resets leverage while physical demand continues quietly underneath. Eventually, the imbalance becomes too large to manage through incremental adjustments. The exchange can raise margins. Banks can hedge exposure. Media can frame narratives. But if physical tightness intersects with macro instability at scale, paper control mechanisms lose efficiency. That is not a prediction of immediate explosion. It is a structural inevitability if current trends persist. The suppression question therefore evolves. It's not, is silver being suppressed? It becomes, how long can suppression continue before it destabilizes the very system attempting to control it? Because every intervention has a cost, and cumulative cost eventually demands resolution. Now we arrive at the critical layer: consequences. If coordinated suppression is occurring, even indirectly through aligned incentives between institutions like JP Morgan and infrastructure controllers such as CME Group, the objective is clear: maintain stability, prevent disorderly upside acceleration, and protect systemic confidence. But stability engineered through containment is not permanent stability. It is delayed repricing. There's a difference. Short-term suppression smooths volatility. It discourages speculative excess. It prevents cascading liquidations from concentrated shorts. From a narrow operational perspective, that can be defended. However, markets are adaptive systems. When participants observe repeated patterns of capped breakouts, they adjust behavior. They reduce leverage. They accumulate physical instead of paper. They migrate away from derivative exposure and toward direct ownership. That behavioral shift quietly changes the battlefield. Paper markets rely on rollover. They rely on the assumption that most contracts will settle financially, not physically. They rely on confidence that delivery is available but rarely demanded. The moment physical demand accelerates beyond expectations, stress moves from price charts to inventory vaults. This is where the narrative becomes larger than silver. Because silver is not isolated. It trades in psychological tandem with gold. It reflects inflation expectations. It correlates with real yield compression. It reacts to geopolitical instability. If suppression keeps silver artificially restrained while macro stress compounds, rising sovereign deficits, persistent currency debasement, growing geopolitical fragmentation, the eventual adjustment must compensate for lost time. Compression does not eliminate pressure, it magnifies it. And when pressure releases, it does so rapidly. Consider how markets behave after extended volatility suppression. Options, markets price complacency, leverage quietly rebuilds, positioning clusters in one direction. Then a catalyst hits, a liquidity shock, a geopolitical escalation, a credit event, a delivery anomaly. The release becomes nonlinear. This is why repeated intervention patterns do not invalidate silver's long-term thesis. They strengthen it. Every time price is forced lower, despite strengthening fundamentals, underlying demand quietly accumulates. Industrial users hedge future supply. Long-term holders increase physical allocation. Institutional investors diversify small percentages into hard assets as insurance. The surface may look calm, but beneath it, allocation shifts. At BullionBeyond, our focus is not predicting the exact week or month of repricing. It is understanding structural imbalance. And structural imbalance is growing. Global debt levels remain elevated. Monetary policy remains politically constrained. Currency purchasing power continues eroding gradually. Industrial demand for silver trends upward structurally, not cyclically. Meanwhile, derivative leverage dominates price discovery. That divergence cannot persist indefinitely. Either physical supply expands dramatically, which current mining trends do not support, or paper pricing eventually realigns upward to reflect scarcity and monetary demand. Suppression delays that realignment. It does not cancel it. Now here is the final contrast. If institutions truly believed silver posed no systemic risk, they would allow pure volatility to play out. Let markets clear freely. Let squeezes occur. Let prices overshoot and retrace naturally. But repeated mechanical containment implies awareness of fragility. Awareness that an uncontrolled silver surge might send a signal larger than a commodity rally. It might signal distrust, and distrust spreads. So where does this leave the investor? Not in panic, not in blind optimism, but in clarity. Short-term price weakness under structural containment is not thesis invalidation. It is evidence of friction between physical reality and derivative architecture. When that friction reaches critical mass, repricing becomes less about speculation and more about necessity. Silver does not need hype. It needs time. And time under pressure builds inevitability. The next explosive move in silver will not begin with excitement. It will begin with disbelief. After years of failed rallies, capped breakouts, and engineered pullbacks, then, suddenly, containment mechanisms will lag. Margin hikes will react instead of preempt. Liquidity adjustments will follow price rather than suppress it. And by the time headlines acknowledge the shift, positioning will already be asymmetric. That is how structural reversals occur. Quietly at first, then all at once. BullionBeyond exists to track the structure, not the noise. Because when the mechanics finally fail to contain the signal, it will not look like a typical rally. It will look like repricing. And repricing, once unleashed, does not ask permission.